Framework for presentation and preparation of financial statements. Chapter Overview. In this chapter, the framework set out for the concept underlying the preparation and presentation of general purpose financial statements prepared by enterprises for wide range of users. The Accounting Standard Boards ASB of the Institute of Chartered Accountants of India issued a framework for the presentation and preparation of financial statement in July 2000. This framework is relevant in context of Companies Accounting Standard Rules 2021, which has replaced Companies Accounting Standard Rules 2006 as amended from time to time, notified by central government and accounting standard issued by the ICAI. This framework provides the fundamental basis for development of new standards as also for review of existing standards. This framework also explains component of financial statements, uses of financial statements, qualitative characteristics of financial statements, and elements of financial statements. The framework also explains concept of capital, capital maintenance, and determination of profit. Introduction. The development of accounting standards or other accounting guidelines need a foundation of underlying principles. ASB of ICAI issues a framework in July 2000, which provided the fundamental basis for development of new standards as follows, also for review of existing standards. The principal areas covered by the framework are as follows. First, component of financial statements, objectives of financial statement, assumptions underlying financial statements, and qualitative characteristics of financial statement. Also, elements of financial statements, criteria for recognition of elements in financial statements, principles for measurement of financial elements, concept of capital and capital maintenance. Purpose of the framework. The framework sets out the concept underlying the preparation and presentation of general purpose financial statement prepared by enterprises for external users. The main purpose of framework is to assist enterprise in preparation of their financial statement in compliance with accounting standard and in dealing with the topics not yet covered by any accounting standards. ASB in its task of development and review of accounting standards. ASB in promoting harmonization of regulations, accounting standards, and procedures relating to the preparation and presentation of financial statement by providing a basic for reducing the number of alternative accounting treatments permitted by accounting standards. Auditors informing an opinion as to whether financial statement conform to the accounting standards. Users in interpretation of financial statement. Those who are interested in the work of ASB with information about its approach to the formation of accounting standards. Status and scope of the framework. The framework applies to general purpose financial statements, hereafter referred to as financial statement, usually prepared annually for external users by all commercial, industrial, and business enterprise, whether in public or private sector. The special purpose financial reports, for example, computation prepared for tax purpose, are outside the scope of the framework. Nevertheless, the framework may be applied in preparation of such reports to the extent not inconsistent with their requirement. Nothing in the framework override any specific accounting standard. In case of conflict between an accounting standard and the framework, the requirement of the accounting standard will prevail over those of the framework. Components of financial statements. A complete set of financial statements normally consists of a balance sheet, a statement of profit and loss, and a cash flow statement together with notes. Other statements are explanatory materials that forms an integral part of the financial statement. All components of financial statement are interrelated because they reflect different aspects of same transactions or other events. Although each statement provides information that is different from each other, none in isolation is likely to serve any single purpose, nor can anyone provide all information needed by a user. The major information content of different components of financial statement are explained as below. Balance sheet portrays value of economic resources controlled by an enterprise. It also provides information about liquidity and solvency of an enterprise, which is useful in predicting the ability of the enterprise to meet its financial commitments as they fall due. Statement of profit and loss presents the result of operations of an enterprise for an accounting period. That is, it depicts the performance of an enterprise, in particular its profitability. Cash flow statements shows the way an enterprise has generated cash and the way they have been used in an accounting period, and helps in evaluating the investment, financing, and operating activities during the reporting period. Note and other statement presents supplementary information explaining different items of the financial statement. For example, they may contain additional information that is relevant to need of users about the items in the balance sheet and statement of profit and loss. They include various other disclosures such as disclosure of accounting policies, reporting, related party disclosures, earning per shares, etc. Objectives and users of financial statement. The objective of financial statement is to provide information about financial position, performance, and cash flows of an enterprise that is useful to a wide range of users in making economic decisions. The framework identifies several broad groups of users of financial statement. All users of financial statement accept the statement to provide useful information needs to make economic decisions. The financial statement provide information to suit the common need of most users. However, they cannot and do not intend to provide all information that may be needed. That is, they do not provide non-financial data even if they may be relevant for making decisions. The aforesaid users use in financial statement in order to satisfy some of their information needs. These needs may include the following: investors. The providers of risk capitals are concerned with the risk inherent in and return provided by their investment. They are also interested in information which enables them to assess the ability of the enterprise to pay dividend. Employees. Employees and their representative groups are interested in information about the stability and profitability of their employers. They are also interested in information which enables them to assess the ability of enterprise to provide remuneration, retirement benefits, and employment opportunities. Lenders. Lenders are interested in the information which enables them to determine whether their loan and the interest to them will be paid when due. Suppliers and other trade creditors. Suppliers and other creditors are interested in information which enables them to determine whether amount owing to them will be paid when due. The trade creditors are likely to be interested in an enterprise over a shorter period than lenders unless they are dependent upon the continuance of the enterprise as a major customer. Customers. Customers have an interest in information about the continuance of an enterprise, especially when they have a long term involvement with or are dependent on the enterprise for their goods and services. Government and their agencies. Government and their agencies are interested in the allocation of resources and therefore the activities of enterprise. They are also required information in order to regulate the activities of enterprise and determine taxation policies, and to serve as the basis for determination of national income and similar statistics. Public. Enterprise affects members of the public in a variety of ways. For example, enterprises may make a substantial contribution to the local economy in many ways, including the number of people they employ and their patronage of local suppliers. Financial statement may assist the public by providing information about the trends and recent development in the prosperity of the enterprise and the range of its activities. Fundamental accounting assumptions. As per the framework, there are three fundamental accounting assumptions. First one is going concern, second one is accrual consistency, and third one is consistency. These are assumptions that is the user of financial statement believes that the same has been considered while preparing the financial statement. That is why, as long as financial statements are prepared in accordance with these assumptions, no separate disclosure in financial statement would be necessary. If nothing has been written about the fundamental accounting assumption in the financial statement, then it is assumed that they have already been followed in their preparation of financial statement. However, if any of the above mentioned fundamental accounting assumption is not followed, then these facts should be specifically disclosed. Let us discuss these assumptions in detail. Going concern. Financial statements are normally prepared on the assumption that an enterprise will continue in operations in the foreseeable futures and neither there is an intention nor there is a need to materially curtail the scale of operations. Financial statement prepared on going concern basis recognize among other things the need for sufficient retention of profit to replace assets consumed in operation and for making adequate provisions for settlement of its liabilities. If any financial statement is prepared on a different basis, that is, when assets of an enterprise are stated at net realizable value in its financial statement, the basis used should be disclosed. Accrual basis. According to AS1, revenue and costs are accrued, that is, recognized as they are earned or incurred, and not as money is received or paid, and recorded in the financial statement of the period to which they relate. Further, Section 128 of the Companies Act 2013 made it mandatory for companies to maintain accounts on accrual basis only. It is not necessary to expressly state that accrual basis of accounting has been followed in preparation of financial statement. In case any income expense is recognized on cash basis, the fact should be stated. Consistency. It is assumed that accounting policies are consistent from one period to another. The consistency improves comparability of financial statements through time period according to accounting standards. An accounting policy can be changed if the change is required by a statute, by an accounting standard, or for more appropriate presentation of financial statements. Qualitative characteristics of financial statement. The qualitative characteristics are attributes that improve the usefulness of information provided in financial statements. The framework suggests that the financial statement should observe and maintain the following four qualitative characteristics as far as possible within limits of reasonable cost benefits. These attributes can be explained as understandability. The financial statement should present information in a manner as to be readily understandable by the users with reasonable knowledge of business and economic activities and accounting. Second, relevance. It is not right to think that more information is always better. A mass of irrelevant information create confusion and can be even more harmful than non-disclosure. The financial statement should contain relevant information only. Information which is likely to influence the economic decision by the users is said to be relevant. Such information may help the user to evaluate past, present, or future events or may help in confirming or correcting past evaluation. The relevance of a piece of information should be judged by its materiality. A piece of information is said to be material if its misstatement can influence economic decisions of a user taken on the basis of financial information. Materiality depends on the size and nature of the item or error judged in the specific circumstances of its misstatement. Materiality provides a threshold or cutoff point rather than being a primary qualitative characteristics which the information must have if it is to be useful. Further, it is important to know the constraint also on relevant and reliable information to better understand the qualitative characteristics of financial statement. Following are some of the constraints. Timelessness. If there is undue delay in the report of information, it may lose its relevance. Management may need to balance the relative merits of the timely reporting and the provisions of reliable information. To provide information on a timely basis, it may often be necessary to report before all aspects of transaction or other events are known, thus impairing reliability. Conversely, if report is delayed until all aspects are known, the information may be highly reliable but of the little use to users who have had to make decisions in the interim. In achieving a balance between relevance and reliability, the overriding consideration is how to how best to satisfy the information needed of users. Balance between benefits and cost. The balance between benefits and cost is pervasive constraint rather than a qualitative characteristic. The benefits derived from information should exceed the cost of providing it. The evaluation of benefit and cost is, however, substantially a judgmental process. The preparers and users of financial statements should be aware of this constraint. Reliability. To be useful, the information must be reliable. That is to say, they must be free from material errors and bias. The information provided are not likely to be reliable unless transaction and events reported are faithfully represented. Transaction and events are reported on the principle of substance over form. The reporting of transaction and events are neutral, that is free from bias. Persuasion is exercised in reporting uncertain outcome of transaction or events. The information in financial statement must be complete. Comparability. Comparison of financial statement is one of the most frequently used and most effective rules of financial analysis. The financial statement should permit both interfirm and intra-firm comparison. One essential requirement of comparability is disclosure of financial effect of change in accounting policy. However, the need for comparability should not be confused with mere uniformity and should not be allowed to become an impediment to the introduction of improved accounting standards. It is not appropriate for an enterprise to continue accounting in the same manner for transaction or other event if the policy adopted is not in keeping with the qualitative characteristics of relevance and reliability. It is also inappropriate for an enterprise to leave its accounting policies unchanged when more relevant and reliable alternative exists. True and fair view. Financial statements are required to show a true and fair view of the performance, financial position, and cash flow of an enterprise. The framework does not deal directly with this concept of true and fair view, yet application of the principal qualitative characteristics and appropriate accounting standards normally results in financial statement portraying true and fair view of information about an enterprise. Let's discuss each element of financial statement in detail. Asset. An asset is a resource controlled by the enterprise as a result of past event from which further economic benefits are expected to flow to the enterprise. The following point must be considered while recognizing an asset. The resource regarded as an asset need not have a physical substance. The resource may represent of a right generating future economic benefits, that is patent, copyrights, trade receivables. An asset without physical substance can be either intangible asset, that is patent and copyrights, or monetary assets, that is trade receivable. The monetary assets are money held and assets to be received in fixed or determinable amounts of money. An asset is a resource controlled by enterprise. This means it is possible to recognize a resource not owned but controlled by the enterprise and assets. That is, legal ownership may or may not vest with the enterprise. Such is the case of financial lease, where leasee recognizes the assets taken on lease, even if ownership lies with the leaser. Likewise, the leaser does not recognize the asset given on finance lease as asset in his book because despite of ownership he does not control the asset. The resource cannot be recognized as an asset if the control is not sufficient. For this reason, specific management or technical talent of an employee cannot be recognized because of insufficient control. When the control over asset is protected by a legal right, that is copyright, the resource can be recognized as an asset. To be considered as an asset, it must be probable that the resource generates future economic benefits. If the economic benefits from a resource is expected to expire within the current accounting period, it is not an asset. For example, economic benefit, that is profit on sale from machinery purchased by an enterprise who deals in such kind of machinery, is expected to expire within the current accounting period. Such purchase of machinery is therefore booked as an expenses rather than capitalized in a machinery account. However, if the articles purchased by a dealer remain unsold at the end of accounting period, the unsold items are recognized as an asset, that is closing stock, because the sale of the articles are resultant economic benefit, that is profit is expected to be earned in the next accounting period. To be considered as an asset, the resource must have a cost or value that can be measured reliably. When flow of economic benefits to the enterprise beyond the current accounting period is considered improbable, the expenditure incurred is recognized as an expense rather than an asset. Liability. A liability is a present obligation of the enterprise arising from past events, the settlement of which is expected to result in an outflow of a resource embodying economic benefits. The following point must be noted. A liability is a present obligation, that is, an obligation the existence of which, based on the evidence available on the balance sheet data date, is considered probable. For example, an enterprise may have to pay compensation if it loses a damage suit filed against it. The damage suit is pending on the balance sheet date. The enterprise should recognize a liability for damage payable by a charge against profit if it is probable that the enterprise will lose the suit, and if the amount of damage payable can be ascertained with reasonable accuracy, the enterprise should create a provision for damage payable by charge against profit. If probability of losing the suit is more than not losing it, and if the amount of damage payable can be ascertained with reasonable accuracy. In other cases, the company reports the damage payable as contingent liability, which does not meet the definition of liability. Accounting standard define provisions as a liability which can be measured only by using a substantial degree of estimate. It may be noted that certain provisions, that is, provision for doubtful debt, depreciation, and impairment losses, represent a diminution in value of the asset rather than obligations. These provisions should not be considered as liability. A liability is recognized only when outflow of economic resource in settlement of a present obligation can be anticipated and the value of outflow can be reliably measured. Otherwise, the liability is not recognized. For example, liability cannot arise on account of future commitment. A discussion by the management of an enterprise to acquire asset in the future does not of itself give rise to a present obligation. An obligation normally arises only when the asset is delivered or the enterprise enter into an irrevocable agreement to acquire the asset. Equity. Equity is defined as residual interest in the assets of an enterprise after deducting all its liability. It is important to avoid mixing up liability with equity. Equity is the excess of aggregate assets of an enterprise over its aggregate liabilities. In other words, equity represents the owner's claim consisting of its item like capital and reserve, which are clearly distinct from liability, that is, claim of party other than owner. The value of equity may change either through contribution from distribution, equity participants, or due to income earned, expenses incurred. Income. Income is increase in economic benefits during the accounting period in the form of inflow of enhanced enhancement of assets or decrease in liabilities that results in increase in equity other than those relating to contribution from equity participants. The definition of income encompasses revenues and gains. Revenue is an income that arises in the ordinary course of business activity of the enterprise, that is, sale by a trader. Gains are incomes which may or may not arise in the ordinary course of activity of enterprise. Profit on disposal of property, plant, and equipment. Gains are showed separately in the statement of profit and loss because this knowledge is useful in assessing performance of the enterprise. Income earned is always associated with either increase of asset or reduction of liability. This means no income can be recognized unless the corresponding increase of asset or decrease of liability can be recognized. For example, a bank does not recognize interest earned on non-performing assets because the corresponding assets cannot be recognized as flow of economic benefits to the bank beyond current accounting period is not probable. Thus, balance sheet of an enterprise can be written in the form of A minus L equals to E, where aggregate value of asset A equals to L aggregate value of liability E equals to aggregate value of equity. The example given above explains the definition of income. The equity increased by 29,000 during the accounting period due to capital introduction 20,000 and income earned 9,000. Income therefore results in increase in equity without introduction of capital. Also note that income earned is accompanied by either increase of assets or by decrease of liability. Expenses. Expenses is decrease in economic benefits during the accounting period in the form of outflow or depletion of asset or incurrence of liability that results in decrease in equity other than those relating to distribution to equity participants. The definition of expenses encompasses expenses that arise in ordinary course of activities of the enterprise, that is, wage paid. Losses may or may not arise in the ordinary course of activities of the enterprise, that is, loss on disposal of property, plant, and equipment. Losses are separately shown in the statement of profit and loss because this knowledge is useful in assessing performance of the enterprise. Expenses are always incurred simultaneously with either reduction of assets or increase of liability. Thus, expenses are recognized when the corresponding decrease of assets or increase of liability are recognized by application of the recognition criteria stated above. Expenses are recognized in profit and loss account by matching them with the revenue generated. However, application of matching concept should not result in recognition of an item as a set, which does not meet the definition of asset or liability as the case may be. Where economic benefits are expected to arise over several accounting period, expenses are recognized in profit and loss statement on the basis of systemic and rational allocation procedure. The obvious example is that of depreciation. An expense is recognized immediately in the profit and loss statement when it does not meet or ceases to meet the definition of asset or when no future economic benefit is expected. An expense is also recognized in the profit and loss statement when a liability is incurred without recognition of an asset, as is the case of when a liability under a product warranty arises. Measurement of elements of financial statement. Measurement is the process of determining money value at which an element can be recognized in the balance sheet or statement of profit and loss. The framework recognizes four alternative measurement bases. These bases relate explicitly to the valuation of assets and liabilities. The valuation of income or expenses, that is, profit, is implied by the value of change in assets and liabilities. In preparation of financial statement, all or any of the measure bases can be used in varying combination to assign money value to items subject to the requirement under the accounting standards. However, it may be noted that accounting standards largely uses the historical cost for the purpose of preparation of financial statement through though for some items use of the other value is permitted, that is, inventory is recorded at historical cost on its acquisition. However, at year end it is valued at lower or cost lower of costs, and net realizable value. A brief explanation of each measurement basis is as follows. Historical cost. Historical cost means acquisition price. For example, the businessman paid 7 lakh to purchase the machine. Its acquisition price includes installation charges is rupees 8 lakh. The historical cost of machine would be 8 lakh. According to this, assets are recorded at an amount of cash or cash equivalent paid or the fair value of the assets at the time of acquisition. Liabilities are recorded at the amount of proceeds received in exchange for the obligation. In certain circumstances, liability is recorded at the amount of cash or cash equivalent expected to be paid to satisfy the obligation in normal course of business. When Mr. X, a businessman, takes a rupees 5 lakh loan from a bank 10% interest per annum, it is to be recorded at the amount of proceeds received in exchange for the obligation. Here the obligation is the repayment of loan as well as payment of interest at an agreed rate that is 10%. Proceeds received are 5 lakhs. It is the historical cost of the transaction. Take another case regarding payment of income tax liability. You know that every individual has to pay income tax on his income if it exceeds certain minimum limit. But the income tax liability is not settled immediately when one earns his income. The income tax authority settles it sometimes later, which is technically called assessment year. Then how does he record this liability as per historical cost basis? It is to be recorded at an amount expected to be paid to discharge the liabilities. Mr. X purchased a machinery on 1st January 2000 X1 at rupees 7 lakh. As per historical cost basis, he has to record it at 7 lakh. That is the acquisition price. As on 1/1/2016, Mr. X found that it would cost rupees 25 lakh to purchase that machine. Mr. X also took loan from a bank as rupees 2 as on 2001 for 5 lakhs at the rate 18% per annum, repayable at the end of 15 years together with interest. As per historical cost, the liability is recorded at 5 lakh at the amount of proceeds received in exchange for obligations and asset is recorded at 7 lakhs. Current cost. Current cost gives an alternative method basis. Assets are carried at the amount of cash or cash equivalent that would have to be paid if the same or an equivalent asset was acquired currently. Liabilities are carried at the undiscounted amount of cash or cash equivalent that would be required to settle the obligation currently. A machine was acquired for 10 rupees dollar 10,000 on deferred payment basis. The rate of exchange on the date of acquisition was rupees 49 per dollar. The payment are to be made in 5 equal annual installment together with 10% interest per year. The current market value of similar machine in India is 5 lakh rupees 5 lakh. Current cost of machine equals to current market price equals to 5 lakh. By historical cost convention, the machine would have been recorded at rupees 4,90,000. To settle the deferred payment on current date, one must buy dollar at rupees 49 per dollar. The liability is therefore recognized at 4,90,000. Note that the amount of liability recognized is not the present value of future payments. This is because in current cost convention, liabilities are recognized at undiscounted amounts. Realizable settlement value. For asset, this is the amount of cash or equivalent currently realizable on sale of the asset in an ordered disposal. For liabilities, this is the undiscounted amount of cash or cash equivalent expected to be paid on settlement of liability in the normal course of business. Present value. Assets are carried at the present value of the future net cash inflow that the item is expected to generate in the normal course of business. Liability are carried at the present value of the future net cash outflow that are expected to be required to settle the liabilities in the normal course of business. Present value P is an amount one has to invest on current date to have an amount A after n years. If the rate of interest is R, then A equals to P into 1 plus R raised to n, or P present value equals to A by 1 plus R raised to n. The process of obtaining present value of future cash flow is called discounting. The rate of interest used for discounting is called the discounting rate. The expression called discounting factor, which depends on value of R and N. Let us take a numerical example assuming interest 10%. A equals to rupees 11,000 and N equals to 1. Year 11,000 equals to 10,000 into 1 plus 1.1 into 1, or present value of 11,000 after 1 year equals to 10,000. Note that a receipt of 10,000 now is equivalent of a receipt of 11,000 after 1 year. Because if one gets 10, rupees 10,000 now, he can invest to collect 11,000 after 1 year. Likewise, a payment of 10,000 now is equivalent of payment of 11,000 after 1 year. Thus, if an asset generates 11,000 after 1 year, it is actually contributing 10,000 at the current date if the rate of earning required is 10%. In other words, the value of asset is 10,000, which is the present value of net future cash inflow it generates. If an asset generates 11,000 after 1 year and 12,100 after 2 years, it is actually contributing 20,000 approx at the current date if the rate of earning required is 10%. In other words, the value of assets is 20,000. That is, the present value of net future cash flow is 20,000. That is, it generates. Under present value convention, assets are carried at present value of future net cash flows generated by the concerned asset in the normal course of business. Liabilities under this convention are carried at present value of future net cash flows that are expected to be required to settle the liability in the normal course of business. Example 7. Carrying amount of a machine is 40,000. The machine is expected to generate 10,000 net cash inflow. The net realizable value of the machine on current date is rupees 25,000. The enterprise required earning rate is 10% per year. The enterprise can either use the machine to earn 10,000 for 5 years. This is equivalent of receiving present value of 10,000 for 5 years at discounted rate 10% on current date. The value realized by use of the asset is called value in use. The value in use is the value of asset by present value convention. Value in use equals to 10,000 into 0.0909 plus 0.826 plus 0.751 plus 0.683 plus 0.621 equals to rupees 37,900. Net selling price rupees 35,000. The present value of the asset is 37,900, which is called its recoverable value. It is obviously not appropriate to carry any asset at a higher value than its recoverable value. Thus, the asset is currently overstated by 2,100. Capital maintenance. Capital refers to net asset of a business. Since a business uses its assets for its operation, a fall in net assets will usually mean a fall in its activity level. It is therefore important for any business to maintain its net assets in such a way as to ensure continued operations at least at the same level year after year. In other words, dividend should not exceed profit after appropriate provisions for replacement of asset consumed in operations. For this reason, the Companies Act does not permit distribution of dividend without providing for depreciation on property, plants, and equipment. Unfortunately, this may not be enough in case of rising price. The point is explained below. As per this point, we have already observed P equals to CA minus CL minus OA minus OL minus C plus D. Here, opening asset equals to OA and opening liability equals to OL. Closing asset and closing liabilities are CA and CL. Introduction of capital equals to C and drawings equals to D. Retained profit equals to P minus D. CA minus CL minus OA minus OL minus C. A business should ensure that retained profit is not negative, that is, closing equity should not be less than capital to be maintained, which is sum of opening equity and capital introduced. It should be clear from above that the value of retained profit depends on the valuation of assets and liabilities. In order to check maintenance of capital, that is whether re- or not retained profit is negative, we can use any of the following three bases. Financial capital maintenance at historical cost. Under this convention, opening and closing assets are stated at respective historical cost to asset a certain opening and closing equity. If the retained profit is greater than or equal to zero, the capital is said to be maintained at historical cost. This means the business will have enough funds to replace its asset at historical cost. This is quite right as long as price do not rises. Example 8. A trader commenced business on 1st 2000 X1 with rupees 12,000 represented by 6,000 units of certain product at 2 rupees per units, and during the year 2000 1 he sold these units at 3 per unit and had withdrawn 6,000. Thus opening equity equals to rupees 12,000 represented by 6,000 unit of 2 per units. Closing equity equals to 12,000 equals to 18,000 minus 6,000 representing entirely by cash, and retained profit equals to nil. The trader can start year 2002 by purchasing 6,000 units of rupees 2 per unit once again for selling them at 3. The whole process can repeat endlessly if there is no change in purchase price of the product. Financial capital maintenance at current purchasing power. Under this convention, opening and closing equity at historical cost are restated at closing price using average price indices. For example, suppose opening equity at historical cost is rupees 3 lakh and opening price index is 100. The opening equity at closing price is 3 lakh 60,000 if closing index is 120. A positive retained profit by this method means the business has enough fund to replace its asset at average closing price. This may not serve the purpose because price of all assets do not change at average rate in real situation. For example, prices of machine can increase by 30% while the average increase is 20%. In the previous example 8, suppose that the average price index at the beginning of the year was 100 and at the end of the year was 120 respectively. Opening equity equals to rupees 12,000 represented by 6,000 units at rupees 2,000 per unit. Opening equity at closing price equals to 14,400. Closing equity at closing price equals to rupees 12,000, that is 18,000 minus 6,000 represented entirely by cash. Retained profit equals to minus 2,400. The negative retained profit indicates that a trader has to pay his maintained capital. The available fund of rupees 12,000 is not sufficient to buy 6,000 units again at increased price of rupees 2.4 per unit. In fact, he should have restricted his drawings to rupees 3,600. Had the trader withdrawn 3,600 instead of 6,000, he would have left with 14,400, the fund required to buy 6,000 unit at rupees 2.4 per unit. Physical capital maintenance at current cost. Under this convention, the historical cost of opening and closing assets are restated at closing price using specific price index applicable to each asset. The liabilities are also restated at a value of economic resource to be sacrificed to settle the obligation at current date, that is closing date. The opening and closing equity at closing current cost are obtained as an excess of aggregate of current cost values of assets over aggregate of current cost values of liabilities. A positive retained profit by this method ensures retention of funds for replacement of each assets at respective closing price. Illustration 2. Summary. Components of financial statement. Balance sheet portrays value of economic resources controlled by an enterprise. Statement of profit and loss presents the result of operation of an enterprise. Cash flow statement shows the way an enterprise generates cash and uses it. Notes, other statements, and other explanatory material presents supplementary information explaining different items. Use of financial statement. Investors. Analysis of performance, profitability, financial position of company. Employee. Knowledge of stability, continuity, and growth. Suppliers. Creditors. Determination of creditworthiness. Customers. Analysis of stability, profitability. Government. Evaluation of entities' performance and contribution to social objectives. Lenders determination determine whether their loan and the interest attaching to them will be paid when due. Public determine contribution to the local economy and public at large. Fundamental accounting assumption. Accrual. Transactions are recognized as and when they occur without considering receipt payment of cash. Going concern. Enterprise will continue in operation in foreseeable future and will not liquidate. Consistency. Using same accounting policy for similar transaction in all accounting periods. Qualitative characteristics of financial statement. First, understandability. Information presented in the financial statement should be readily understandable by the users with reasonable knowledge of the business and economic activities. Relevance. Financial statements should contain relevant information only. Information which is likely to influence the economic decision of the user is called relevant. Reliability. Information must be reliable, that is to say, they must be free from material errors and biases. Comparability. Financial statements should provide both inter-firm and intra-firm comparison. Elements of financial statement. Assets. Resource controlled by the enterprise as a result of past events from which future economic benefits are expected to flow to the enterprise. Liabilities. Present obligation of the enterprise arising from past events, the settlement of which is expected to result in an outflow of resource embodying economy benefits. Equity, residual interest in the assets of an enterprise after deducting all its liability. Income gain, increase in economic benefit during the accounting period in the form of inflows or enhancement of assets or decrease in liabilities that results in increase in equity other than those related to contributing contribution from equity participants. Expenses, losses. Decrease in economic benefits during the accounting period in the form of outflow or depletion of assets or incurring of liability that results in decrease in equity other than those relating to distribution to equity participants. Measurements of elements in financial statement. Historical cost, acquisition cost. Current cost assets are carried at the amount of cash or cash equivalent that would have to be paid if the same or an equivalent asset is acquired. Currently, liabilities are carried at the undiscounted amount of cash or cash equivalents that would be required to settle the obligation currently. Realizable value for assets amount currently realizable on sale of the asset in an orderly disposal. For example, liabilities, this is the undiscounted amount expected to be paid on settlement of liability in the normal course of business. Present value. Assets are carried at present value of future net cash flow generated by the concerned assets in the normal course of business. Liabilities are carried at present value of future net cash flow that are expected to be required to settle the liabilities in the normal course of business. Financial capital maintenance. At historical cost, opening and closing assets are stated at historical cost. At current purchasing power, restatement at closing price using average price power. Physical capital maintenance, restatement and closing price using specific price index.